As we move into this world of tokens and chains, who will be the wallet provider?
Hello, everyone, and welcome to the Future of Finance is Open. This is episode 2 of the podcast. I'm Ian Horn, and I am co-hosting with Aaron J. Katakam. Aaron J., I want to bring you in right at the start. I know we did this the first episode too, but for anyone who doesn't know, tell them a bit about the book. Tell them a bit about the Future of Finance is Open and why you've written it.
Thanks, Ian. So the book is set at a conference in 2032. It's looking at the future of open finance. That is not guaranteed, just a vision. And it's our efforts in these next 6 years that's going to make this come to life. So I walk the reader through the conference and talk to different people I'm meeting at the conference, explaining how it was done. So it's a way of taking a topic, making it accessible using a conversational style. So rather than reading a white paper on the topic, and sorry, Tony, I know we're going to talk about your white paper, but it's more about people engaging with the narrative and understanding the possibilities of what this transformation has in store for us.
Great stuff. And you've done the big reveal already for people listening on kind of audio only. Our guest today is Tony McLaughlin, CEO of Ubix. Tony, I'm looking forward to having a big conversation with you here. Full disclosure, I mean, I usually introduce myself as the author of Why DeFi Matters. I'm also now the fractional CMO of Ubix. So if I'm being too nice to Tony, Aaron J., you've got to step in and have some words here and ask some brutal questions. But hey, I think Tony's doing some really cool stuff, which is why I'm now working with him. So let's get into question 1, which is, firstly, Tony, like, great to have you here, firstly. It's the first, coming up to the 1-year anniversary of the Ubix white paper, which is obviously a big moment in the company and also for you personally, because the response to it has been pretty huge. So could you talk us through what's happened since then and also the reaction you've had to the white paper launch?
Please don't prematurely age us. The white paper was released on March the 24th last year.
Yeah.
It's only the beginning of Feb. But yeah, where did the white paper come from? It came from a simple observation that in the world of when money becomes tokens, the tokens represent something ancient, which is just a promise to pay. One of the building blocks of finance are promises to pay, and whether you represent those promises to pay on paper or clay tablets or papyrus or relational databases or tokens, or in the future some other undreamt of technology, the market structure is predictable. And the market structure that was clear to me when it comes to tokenized money is there are many issuers of tokenized money. And those promises have to be accepted by many accepting parties. That looks very similar to check clearing or ACH clearing or indeed card clearing through Visa and MasterCard. So the white paper simply says, hey, these tokens are coming along, but they will need to be cleared. And here's a way in which a clearing system for tokenized money can be constructed. Which is essentially check clearing for tokenized money.
Yeah, and how have people responded to that? Because obviously there are people across a broad spectrum that will be reading, that will have read the white paper, from DeFi natives all the way through to banks. How has the response to the paper been? Has it been polarized at all, or have people more or less kind of gotten on board with what you're saying?
I think the polarization are people who haven't read it, to those who have read it multiple times and who really, really, really liked it. And then folks who have had their AI summarize it for them. I mean, it's 56 pages long. Who's got the time to read 56 pages?
You're speaking to two published authors, Tony.
Right. So folks are just, the attention span isn't there anymore. I mean, look, it was crazy to me, the number of people who I would get into conversations with about blockchain and Bitcoin, and I'd be half an hour or an hour into a conversation with them, and then I just innocently ask, have you read the Bitcoin white paper? And it was like, oh, no, I haven't. and that's only like 9 pages long.
There's
So-
nothing. Yeah, the Bitcoin one's easy.
Right. So sad that people don't read, but there's a lot of content. I understand that. The reaction of people who have read it has been positive. Nobody yet has offered to buy the when I published it for fun, I minted an NFT that immortalized it. Nobody's bought that NFT yet, so it's there for posterity reasons. But I kind of feel like I won the game already when I published the white paper, when I pressed publish on it, because whether Ubix as a company is successful or not, I think the thesis that was presented in the white paper is super strong. And I also have this, for the past almost a year, I've been living with this uncanny feeling that I had a kind of insight into what the future is going to look like, at least a slither of the future. And I do think that there's an inevitability about some of the forces that are being unleashed. And in particular, I very much believe that general purpose technologies like tokens on chains, if given half a chance, they take over from the special purpose technology. So the transition there's a big technological transition coming. And I'm excited that Ubix is part of it.
Totally. And Tony, I just want to jump in here because I read the paper, probably a draft version in December 24.
Yeah.
I mean, you didn't send it to me, so you know how these things travel.
Right.
But at the time, I was thinking, this either Tony's going to be right on this thesis and it's going to go this way, or we're going to go into just Circle and Tether being the Visa and MasterCard and them doing all of the clearing themselves. And we don't have this multi-coin world. This is so December 24, right? And then 25 turns up, and then we have Genius Act, Summer of Staples, all of this. And clearly now, this thesis is the way it's going.
That's what I predicted, and I believe that we're only at the very beginning of that movement. One thing that I kind of saw during the past year is the banks are not willing to sit by and see stablecoins have all the fun. So banks are very determined that tokenized deposits will have their place in the ecosystem. I think they're also supported by a number of central banks who want to see tokenized deposits have their place in the ecosystem. But tokenized money, whether it's a stablecoin from a regulated non-bank or a tokenized bank deposit, or other cash-like instruments, yield-bearing like tokenized money market funds, these things are super interesting. And I also, over the past year, I'm even more convinced in another part of the thesis, which is every bank and fintech on the planet will offer wallets connected to many chains. I'm absolutely convinced of that. Every bit of evidence that I see points towards that. So I think that by the time, which is portrayed in your book, everyone on the planet will have the ability to hold tokens that represent different kinds of digital assets with their chosen bank or fintech. And I'm not against self-custody wallets at all. I'm all for I have self-custody wallets myself. They're not doing too well these days, but I have them. And it's great to have that kind of pluralism. The trouble is that in today's world that the supply of wallets provided by banks and fintechs has been inhibited by well-meaning regulation. But the effect of that well-meaning regulation is you can't just get a wallet from your bank. That's going to change.
Yeah, absolutely. You've covered several things that we plan to talk about later on. I'm going to go back to an earlier point that you've made. Well, actually, it's in reference to your LinkedIn profile, because having been an events organizer and speaker booker, I spend way too much time looking at people's LinkedIn. And I noticed that change on your profile from stablecoin maximalist to something new, which kind of suggests that shift towards tokenized cash, right? Could you talk us through that journey? Do you still believe ultimately that we end up with stable coins as the end point, or is it more about having a broader view of what falls into Ubix's remit?
Well, in the white paper, I tried to say that, look, whether you've got a token which is redeemable at par value on demand, and that token could be issued by a regulated non-bank or a bank against its fractional reserve balance sheet or by a central bank. And I said that essentially, I believe in the fullness of time, all of these things are just stablecoins. But I have to recognize that at the moment, when you say the word stablecoin, people think about a particular kind of instrument, which is a pre-funded instrument. So I just wanted to be a bit more inclusive about it. And also I wanted to show a path to the banks, because if the exam question is, how can tokenized deposits be competitive with stablecoins? Then you set off on a path with a series of constraints that really you can only end up in one place. So those tokenized deposits must become interoperable, but they must also remain whitelisted instruments, meaning that someone must have done the KYC on the wallet holder, and they probably, I think they must transfer on networks that can support transaction privacy. So when you set the exam question up and say, how can tokenized deposits be competitive with stablecoins, given their attributes, you kind of, as you prune the decision tree, you kind of end up going in a particular direction. And that for me led to the cash management, the corporate cash management use case. I believe that if banks want tokenized deposits to be useful in the world, then the best use case to begin with is corporate cash management.
Yeah, and that leads us on to the next question, actually, which is, one of your more provocative views lately has been about the potential shift of treasury accounts from traditional banks to wallets. So what does a world of wallets look like, and what does it mean for the banks?
Yeah, this is to me, again, a paradigm shift. We're all of an age where if you ask the question to folks of, I mean, you're younger than me, Ian, I know this, and you, RNG, you're also, but still, if I ask you the question, how much money have you got, you think towards your bank balance, whereas the wallet construct is different. A bank account is a kind of one-trick pony. Like, Ian, your bank account with a UK bank only contains one kind of instrument. It's a liability of that bank. It's a deposit with that bank in a particular currency. When you enter into the world of wallets, the wallets can be connected to multiple chains, and they can contain tokens that can represent lots and lots of different types of instrument. So they're fundamentally multi-asset. So here's the challenge for banks, or the question for banks. As we move into this world of tokens and chains, who will be the wallet provider? Now, if you're a bank, you kind of want to maintain the customer interface. So if Ian is going to have a wallet full of lots of different digital assets, your bank probably wants to offer you that wallet, because they want, and the reason for that is the core of that relationship. They would like that to be, your bank account, where all of these assets are coming in and out of your bank account. The fungibility core is your bank account. So that's in the interest of the bank or the fintech. But strangely enough, very few banks are gearing up to win in the world of wallets. In fact, I can think of almost no bank in the world which is gearing up to win in the world of wallets, with the very few exceptions to prove the rule. So just as a bank, ask yourself this question: if there's a tokenized deposit and your customer is holding that tokenized deposit in an exchange wallet, are you happy with that? I think if they're holding your tokenized deposit at all, it's better than nothing. But if they're holding your tokenized deposit in an exchange wallet, you've lost the relationship.
Absolutely. So I think neobanks, though, taking a sort of a leap into this, right? So they're trying to offer this, certainly able to hold different tokens, coins within that interface. I see also, like you, this wallet being critical, and I worked in financial inclusion, mobile money for a long time, and mobile money wallets was a bad term. So we spent a lot of time changing it to mobile money accounts so that
Yes.
everyone was like, and here we are going back to wallets. But I also believe it'll not just store money and tokens, it'll also store documents. So a wallet, if you look at, I haven't carried a wallet in 10 years, but before that, had a ID and, money and some photographs and some receipts and, data. And, being able to cryptographically sign all of that. And now, like, for example, in India, it's called the DigiLocker. It exists. It's over 1 billion people have them. This is not something that we're talking about from the future. It is here. And so, yeah, I totally agree that this is where we're heading. And it's going to be fascinating to see how everyone jockeys through this transformation.
Yeah, actually, if I could piggyback on that, Aaron J, you're right. This is really global as well. So, Tony, where would you expect demand to kind of arrive first internationally?
Internationally, here, look, I tend to follow the money and follow the incentives. And, one incentive that I think is quite clear is if there's going to be a global circulating supply of dollar stable coins, then that creates a latent foreign exchange opportunity, meaning that if you're a bank or a fintech in a country and you can provide wallets to your customers and catch those stable coins and convert them to local currency, you make FX. And so I can imagine that we will see PSPs in those receipt countries opening up wallets, and then the banks will begin to notice and they won't want to be left behind. So then they will open up wallets. I think that there is an inevitability that every bank and fintech on the planet has wallets for their customers. And this, by the way, is a good thing. The reason why it's a good thing is because, again, I have nothing against self-custody wallets for those who want it, but giving people the option to hold a wallet where they have been KYC'd by a regulated institution makes the whole system safer. So I'm very much, I think if I was, many countries, they look upon the rise of stablecoins and dollar stablecoins with some trepidation. I think there's a way of turning it from a threat into an opportunity. And that the way of doing that is you encourage the local institutions, the folks that you've given a license to, you say to them, look, we need you to catch the stable coins in wallets that you provide and ideally convert them into local currency. And that's a way to turn the fear into an opportunity.
So, Tony, I want to touch on the business model question because the interest rates went up in about 2022 and Circle and Tether really leveraged that in a very interesting way to grow their businesses. But it's unlikely that's going to stay forever. We know the banks have very strong business models, asymmetric lending. So it's through this fintechization of everything, which I absolutely believe in. How do you see this business model shifting, and how are the Circles, Tethers, and other issuers of the world going to sustain it?
Great question. Again, stable coins at 1% rates are very different from stable coins at 4% rates. And it does seem that we're entering into a lower interest rate environment in the not too distant future. So I think you can conclude that a business model which is entirely based upon rates is not sustainable. And so non-interest income streams will have to be generated. This is something which is intrinsic into the UBIX clearing system. In that clearing system, we generate a non-interest earning stream for the issuer. And that is necessary if stablecoins are going to be a sustainable business model. I think the other thing that needs to be clear for sustainability is this whole movement cannot be dependent upon crypto prices. So things that are volatile, like there's a cycle of interest rates and there's volatility in crypto prices, these are not the things that are going to, well, these things will definitely accelerate and decelerate adoption. But in the longer term, or even the medium term, I think something deeper and more technological is going on, which is the general purpose technology, when given half a chance, subsumes the special purpose technology. So if you, let's say that you are, I remember back in 2008, I was at Citibank and I led the bank's investment to become a member of the faster payment scheme. Faster payments were mandated in the UK, so all the banks had to invest in it. And the cost of building faster payments, you know, we're talking about hundreds and hundreds of millions of dollars. And the question is a faster payment circuit which is standalone, is that a special purpose circuit? And what can you do on that circuit that you can't do on a private permission blockchain, which is general purpose? So countries, this is a little bit like a country saying, well, I'd like to have telephony in my whole country. Am I going to copy other countries and dig into the ground and put down copper wires? Or am I going straight to mobile? Now, clearly, you're going to go straight to mobile. So going forward, a lot of the legacy payment systems are going to come up for renewal. And then countries will have to say to themselves, do I really want to spend several $100 million replacing a legacy payment system with another dedicated pipe? So I think over time, the general purpose technologies will win. Now, that's not to say that a country might say to itself, look, I'm willing to invest in a special purpose pipe for national security reasons. I can't afford my faster payment system to be living on a public blockchain that I don't control. But that decision will be a positive decision to spend more on something special purpose for a non-performance and non-financial reason. That's perfectly fine.
That's fascinating, Tony. So, because essentially, like, you know, when I look at it in the 1990s, and you know, this exactly landline versus mobile thing, the US had put landlines in everyone's house in the 80s, and in Africa and Asia, they were like, "Oh, do we need to do the same thing?" No, we put mobile, right? Like, so in the early 2000s, you just had mobile going everywhere. But in Africa today, they're still trying to put payment systems in. Instant payment systems, there are like 30 odd systems, and more countries are trying to do this. And then you have someone like PAPS, and you have different regional systems as well. And there's a business model issue. They're just too expensive to run, too expensive to use, very low adoption. None of them have escape velocity, like as compared to India, Brazil, Singapore, other countries where the uptake's so high that the ecosystem it just gets created. The flywheel is there. So are you saying essentially that we're going to get to the internet of money in a way in which you absolutely don't need, like, even faster payments in the UK, except for national security, and like leaving that aside, just from so that's my question.
So let's think of I think what I'm about to say, I think is a very good planning scenario, because I believe that this is what will happen. So let's say that you have a medium-sized country like the UK, where every bank and fintech in the country have wallets, and those wallets are connected to 10 different blockchains. And those wallets are able to transact in tokenized deposits and stable coins and tokenized money market funds and tokenized stocks and tokenized bonds. Where will the traffic end up? Where will the traffic end up? I believe that the intrinsic benefits of the general purpose technology will mean that the traffic will end up flowing over those blockchains. And that means that the traffic over the legacy rails like ACH and faster payments may well diminish. The innovation might start taking place upon the public blockchains. And folks will vote with their feet. So you will have these two worlds. You will have the world of accounts. And think about it. What is a check, an ACH, a faster payment, a SWIFT payment? These are all methods for moving money between one account and another account. They're all in the account paradigm. So you've got two paradigms. Paradigm one is the account paradigm and all of the rails which are designed to move money between accounts. And paradigm two is the token chain paradigm, token chain wallet paradigm. And I think we're going to get to a place where the account paradigm looks very limited in comparison to the new paradigm. So this point in time, I would say predictions, 3 years from now, I think you're going to see signs that everyone's going to have a wallet. And people will start transacting in tokenized deposits. And look, once everyone's got a wallet, Web3 and TradFi have merged. That is the merger between TradFi and Web3 when everyone has a wallet. What I say to bank executives is this: do you believe we're entering into a world of tokens and chains? They say yes. Do we know which token or chain will win? No, nobody does. But if you believe that that's the way that we're going, then the table stakes for you to survive in that new realm is to have a wallet. And that wallet can be connected to many different chains. It's an insurance policy. It's a very cheap insurance policy. For a few $100,000 per institution, you can future-proof your organization to be able to survive in the world of tokens and chains. So the first thing, lots of banks and other regulated entities, they're scratching their heads saying, what do I do, or what do I do first? The first thing that you do is you get a wallet infrastructure. That's the first thing.
Yeah, that's absolutely fascinating. And one thing you mentioned there is the existence of multiple chains and also, I guess, competing commercial interests. So one of the key questions in the transition to Web3 is that horrible word, interoperability, which I'm glad I've pronounced correctly. For Ubix, how do you actually kind of act as the glue between the different systems that are out there? Because as you touched upon, there are different chains that could be competing. There are obviously numerous banks, fintechs, governments, even existing payment service providers. You could throw them into the mix as well. How do you create a system that everyone wants to use without the bottlenecks and the commercial conflicts that you might otherwise expect, right?
Ian, that's such a softball question, right? I know you've come on board as like fractional CMO. This, when Melania got asked, I really want to know what time of day is your paper.
Yeah, what's your favorite color and why?
Yeah, it's just so low class to sell on a
wow.
So
terrible, isn't it? It's not what you expect from your CMO.
I'm just not going to do it.
Aaron, you were meant to step in before I did that. So,
but I can tell you that interoperability is a precondition, and in any look, this is not just about since it's a Friday afternoon. Let's get slightly abstract about it. This is not just about Earth. If and when a UFO ever lands on the White House lawn, that UFO was not paid for in cash, and it was not bartered. The components were not bartered, and it was not paid for in cash. That UFO was financed. So everywhere, every sophisticated civilization, because money and finance is a technology for orchestration. That is an orchestration technology. So that UFO has got some lease on it, the first thing to ask the alien when they come is, a nice vehicle, how much have you got left to pay off? Everywhere that there's civilization sufficiently advanced, there is debt, there are promises to pay. All of these places have also got multiple competing issuers of that debt. And those instruments have to be accepted in multiple places. And you end up with a many-to-many network. And many-to-many networks, if they're resolved bilaterally, the number of connections is A times B. And if they're resolved through a clearing system, the number of connections is A plus B. So it's math. There needs to be something that resolves the many-to-many network. Again, that's what the Ubix white paper argues. It needs to be true for tokenized money, as it was true for checks, as it was true for ACH, as it was true for cards, needs to be true for tokenized money. So I think these are just elementary. These things are just true. Now, whether Ubix is successful in occupying that space, that's a different question.
So I want to challenge you here, Tony, because, I at the heart, I believe interoperability is key. I agree with you, but that's not what we're seeing. The internet is that interoperability there, the 1.0 version. Then 2.0 came along, and what did we see? Walled gardens. And, mobile, another walled garden. Android is the greatest Trojan horse ever, probably, right? Like open, but not open. And so two big players. Now the AI world is taking over. Again, the big distributors are at it. So what we are, what this last sort of 15 years has showed us is that if you get big enough, and again, Visa, MasterCard, another example. So if you get big enough, you don't need to be interoperable. You can create enough of a scale, Facebook, 3 billion, whatnot, that you can stay closed.
There are definitely aggregation points and natural monopolies or oligopolies in certain places, but it's not always the place that people think it is. So let's take cards, for example. If we were in the late 60s, early 70s, what would we observe? Only a few credit cards issued by American companies. And we might be on where there were no podcasts, or let's say that we were on radio then discussing the development of credit cards. And we might say, well, the world is going to be overrun by two big US dollar credit card companies. Now, fast forward to 2026, that hasn't happened. Of course, there are very big credit card issuers, but globally there are 16,000 or so issuers. So there's no power law in issuer, which means that only 2 or 3 issuers of credit cards can survive. There are many, many, many issuers of credit cards. Of course, there is a kind of power law that means that there's only a few schemes that connect them together, like Visa and MasterCard. And there are very few examples of successful proprietary issuers. The only 3 examples that one can raise are, Diners Club, Discover, and American Express. And, some of these ones are really great businesses. I'm an Amex customer myself, but it's not as valuable as the many-to-many network. So I think that the form factor of the instrument, again, whether it's a piece of paper or a piece of plastic or a block of marble or a token, you can look through these form factors and you can see a market structure that has to emerge.
Right. Yeah. So I take your point on the issuers of the card network, the 16,000 on. But I'm still not convinced that the market, like I said, I agree with you in hypothesis and theory, but the market is going a different direction. Coinbase and Circle and all of these guys are not trying to be, they might use open language, but they are not really trying to open the network. Everyone is trying to do a land grab, a massive land grab.
It's a point in time.
Right. Okay, fair.
That's a point in time observation. I'm dumb enough to put out there what I think is a thesis of how the market will evolve. It's a prediction. I think it's based on solid historical precedent, but not only that, it's based upon commercial incentives. If you look at the incentive, so I think something is always, if you're looking at the evolution of a game like the tokenized money game, you look at the incentives of the governments, you look at the incentives of the issuers, you look at the incentives of the banks and the fintechs and the exchanges, you look at the incentive of governments around the world and central banks around the world. You add all of these things up, at least when I tot up all of those incentives, what I see is a pluralistic market structure with thousands of issuers, and everyone has the ability to receive these instruments into their wallets provided by their banks and fintechs, and no fragmentation. If Ian, I don't know who you bank with, Ian, but let's say you bank with NatWest, and you walk into a hotel in Iceland. The hotel in Iceland doesn't give a damn about your bank. They don't care about the balance sheet of your bank. I mean, this is the other thing about a point in time. Everyone at the moment is obsessed with the balance sheet of the issuer. All of the regulations are to do with managing prudential regulations about managing the balance sheet of the issuer. In the cards world, that has been completely abstracted away. You know, when Ian walks into that bar in Iceland, the balance sheet of the issuer is not relevant. It's been taken care of. And this will also pass in the realm of tokenized money. Nobody will care about the balance sheet of the issuer as long as institutional arrangements have been created to make that a reality. And that means the creation of a clearing system. Clearing systems are designed to homogenize the issuer. And that feature is also very, very close to something the central bankers care about, which is singleness of money. Singleness of money means the issuer doesn't matter. And in the realm of tokenized money, we have to get to the point where the issuer of a token that says it's $1 doesn't matter. That's where we will get to.
Yeah, I think before, we're going to see a few people, so many different scandals,
Sure.
all of those things. I guess we have to go through all that history has shown us as well, right? So
I have no doubt.
Okay, we'll have to move this along because we're running out of time, which is a shame because I feel like we could do another hour here quite easily. But let's look forward. Let's look to the future, Tony. It's, as I say, we're coming up to a year. I know it's not as close to that year as you might think, but by the time we put this out, it will be closer. What are the big milestones you're expecting over the next kind of 6 to 12 months for UBIX and also, relevant industry developments?
Yeah, so we, like any other startup, we've got to find the golden snitch, otherwise known as product market fit, get the flow going through the pipes, and build the business and build the build the company and build the business. And we want to help regulated financial institutions and help central banks, let's say, responsibly adopt the new technology. And I think there's part of that which is education, but education isn't as powerful as, in Hollywood they say, show, don't tell. So I want to show banks, or I want to help show banks that their tokenized deposits can be really competitive with stable coins in the cash management use case. I want to show banks how they can make money, and fintechs how they can make money from accepting stable coins. I want to show stablecoin issuers how they can make non-interest income. I want to help show central banks and policymakers that this new technology can, again, be responsibly incorporated. And what that means is, in a nutshell, dramatically increasing the supply of wallets provided by responsible regulated financial institutions. So the company mission is stablecoin ubiquity, or tokenized money ubiquity. And that is not something any individual company can achieve by itself. So the other thing, referring back to the white paper, we operate on the stone soup principle. For those who are not aware of it, it's the old story of someone who walks into an impoverished village. Everyone is very bedraggled. Everyone's downcast. And the guy walks in and says, I'm going to make a delicious soup that everyone's going to enjoy. And he pulls out a stone from his pocket, and he's got a cauldron and fills it with water, starts walking around the cauldron and says, all I need is a bit of kindling to get this thing going. So someone goes off and brings some kindling, and the fire is started, and the water starts bubbling. And he looks in and said, it would be great if we had a couple of onions here. And someone rushes off and gets the onions. And you can see where this story goes. He says, if only someone's got some carrots and maybe a few scraps of meat. And by the end of it, when everyone has contributed what they had, there's a delicious soup for everyone to enjoy. But the moral of that story is there was a coordination problem. The coordination issue was solved by the stranger with the stone. Everything that's necessary for us to adopt this technology in a very positive way exists in the community. If the issuers and the banks and the fintechs and the regulators and the wallet providers and the blockchain analytics providers and everyone in the community just brings an onion or a carrot or a scrap of meat, and we can create something really, really good. And what that is, is actually is a more open financial system. When your bank has a wallet connected to 15 different blockchains, that's a much more resilient institution than one that's just connected to special purpose rails.
Absolutely. And I think that's such a great story. It seems to me that everyone still wants to hang on to the onions and their carrots and scraps of meat. They all want to make their own soup, and they all want everyone to have their soup. That's where we seem to stand today, at least the way I'm seeing it. And so, Tony, what are the biggest blockers? Like, what do you see? Why are people hanging on to their onions and carrots? What is blocking the uptake from your perspective?
Last year, the BIS published a report about all of the deficiencies of stablecoins, and I thought that was a missed opportunity. Rather than focus on blockers, I rather recast the question as what needs to be true. What needs to be true, and are those things within our grasp? So what needs to be true is that regulated banks and fintechs need to be encouraged to participate in public blockchains. For that to happen, we've got to overcome one of the major impediments, which is how do you engage with the public blockchain through your kind of like outsourcing framework? All banks have got this thing called third-party risk management. Do I have to apply third-party risk management to a public blockchain? It's very difficult to do that because you've got a 100-page questionnaire. Where do I send the questionnaire? But the truth is that banks and fintechs not engaging with public blockchains creates a vacuum. So if Ian wants to transact on Ethereum, but Ian can't access the services of his bank, he is forced to transact with someone else. And that may well be with an unregulated party. So we need to think of these blockchains as venues. We are comfortable with a bank branch being placed on a street in a dangerous town, and we don't expect the branch to be responsible for everything that happens on that street. And in fact, we would probably say to ourselves, the fact that the bank branch is on that street makes the street less dangerous or makes it better. And that's the same with public blockchains. The regulators have, again, through the abundance of caution for good intentions, they've prevented the banks and fintechs from setting up on those streets. And that has created a vacuum. That was not the right policy. So it seems to me that if I wanted to say blocker, or what needs to be true is that we chart a common course towards the responsible adoption of this technology.
And we achieved that with the cloud, right? 10 years ago or so, no banks were on the cloud. And now, so that on-prem, everything had to be on-premise, and now they've adopted the cloud.
But look how difficult that was, and it's not even complete. And big banks still will not put core systems onto the cloud. So even the cloud, which is much easier than public blockchain to get through third-party risk management, because at least there's a third party you can send the questionnaire to, that transition hasn't been completed. But anyway, it does remind me of a joke, which is, they say that there's no such thing as the cloud, it's just somebody else's computer, right? But blockchain, you could say there's no such thing as blockchain, it's just somebody else's ledger on somebody else's computer. So it's the difficulties of moving to blockchain are greater than the move to cloud. The benefits of the move to blockchain, I think, will reveal themselves over time.
Okay, I think we've got time for one more question, and this is again future looking, and that's the end game, or at least the game 5 years from now. If Ubix succeeds in what it's trying to do, what does the global movement of money look like 5 years from now?
I think it means that over time, the default way of transferring and storing value is a token on a public chain. And again, who will be the issuer that wins? I don't know. Who will be the chain that wins? I don't know. But I do have a strong intuition that tokens on chains are the general purpose technology that subsume the special purpose technology. In the same way, and I apologize if people have heard me say this before, but in my life, I used to have an alarm clock beside my bed. It worked fine, woke me up. Why did I need the alarm clock to transition into the phone? I didn't. The alarm clock worked fine. I had a calculator. I had a Casio calculator. Worked fine. Why did I need the Casio calculator to transition into the phone? I didn't. The calculator worked fine, but it did anyway. I had a Walkman and an iPod. Why did I need that to transition into the phone when it played whichever music I wanted? So people make a big mistake, which is they look at what we've got today and they say it works. So why would I transition? This is an illusion. If you don't believe in the illusion, go and dig out your old alarm clock, your old Walkman, and your old Casio calculator and take a hard look at them.
Yeah,
those might come to resemble the ACH, the card network, and the faster payment system. Just because something works today doesn't mean it doesn't get replaced. I cannot tell you, when I had my Nokia feature phone, I genuinely had the sense, for people who can remember this, I thought to myself, how can anyone design such a simple user interface? It was the Nokia feature phone was beautiful. And then along came the BlackBerry, which people at that time called the Crackberry. And I said to myself, how can there be anything better than this device? When I joined Citibank in 2004, one of the major reasons I was excited was to get my hands on a BlackBerry. And then along came the iPhone. And the previous devices were subsumed within that form factor. So the stuff that we use today might work. It's absolutely it's bad reasoning to say that something will not be replaced because it works.
Yeah, absolutely. Aaron J, I'm about to wrap this up, but any final thoughts before I do that?
I mean, this was a fascinating conversation, and I really appreciate it, Tony. Really, this brings so much of the abstract into something more tangible. I love the analogies and the stories and future casting. I know you said you're dumb enough to do that, but I mean, there's no fun in life if we don't actually kind of take a shot at it and make a stake at what this is going to turn out to be. So
Right.
it's been great having you. Thank you so much.
Yeah. Thanks, guys.
Yeah. Great stuff. Thanks, Tony. Thanks, Aaron J. And thank you for everyone who's been listening. This has been The Future of Finance is Open.